Okay, join me coming up next for some talk about UVXY and the markets here on the Short Vol Show Live. And welcome back to the Short Vol Show Live. My name is Dave. Congrats to everybody who did make money last week with volatility coming in. I know things happened real quickly as we came out of that midterm elections day. All of a sudden stuff was like straight down. If we look at the VIX, it just sort of tanked off of that the election results, which was pretty much what was expected. You can see it off to my left here, just that little gap down there. Really sold off nicely. And then we got back into a little bit of a bid caught on the VIX on Thursday and Friday. If we look at the action there, let's go to UVXY here. You can see Thursday and Friday caught a little bit of a bid back up. However, term structure did finally get out of backwardation and back into Contango and has been in Contango the last two sessions. So that's good news for short vol trade people. I know a lot of people got hurt on the run up here and are definitely a little bit afraid to put their toe in the water right here. But if we just kind of stay a little bit calm here, then we will remain in Contango, and then we can just watch the stuff slowly move lower. Now the question always is not when is it going to go lower, but I'm sorry, the question is not whether it's going to go lower, but when it's going to go lower. And so I've been employing some different strategies. I got a whole bunch of questions lately. I've been on sort of hiatus for the last few weeks, but I did get a lot of questions, so I've got some great material for the next couple shows. You can see the chart next to me here. We are in Contango by 0.68%, which is not a lot, but Contango is Contango, folks. I guess it was a 29-day run of backwardation, which is a pretty long time to not be in Contango. This has been a tough year as far as the short vol trade goes. And I'm going to outline a couple different strategies to kind of hang in there. You know, it's been hard to just put a big short delta on in a UVXY or VXX because it's gone against us a lot, and it becomes this timing thing. And, you know, I have talked about going farther out in time for a put vertical or a short call spread. But, again, people have gotten run over a lot. And so I wanted to just talk a little bit about this strategy of buying calendar spreads. And the basic idea here is we know that this is going to move lower over time. We can kind of select some sort of price target over, you know, generally over the next few months. So, you know, if you say, well, Contango is 5%, and it's a $30 stock, and, you know, it's probably going to move down about $2 per month based on decay of it decaying 5%, then you can kind of get targets, and you can enter into a calendar spread. And the beautiful thing about a calendar spread is that you collect money every day. It's positive theta, and also as time goes by, your short delta, if you're, you know, above the strike, your short delta is going to increase. And so if you slowly move to strike, you'll do very well. The other nice thing about a long calendar spread is it is a long Vega position, and what that means is that if UVXY does spike and implied volatility in UVXY's option goes up, that will work in your favor against the short delta, which would work against you on a spike. So, for example, here, if we look at UVXY over the last 180 days, say, and that's not a 180-day chart. that's a 20-day chart. But let's look at it over the last year, okay? We can see, if I just move over a teeny bit here, that I feel like I'm too big in this picture. Hold on. We can see that it's kind of marched slowly down since the beginning of the year from this sort of 80s range down, and it got down to 35. Now it's back up around 50. So you might think, well, if we kind of extrapolate out, maybe it'll be 35, 40 in another month or two, or 3. So if we say maybe like 2 months, it's going to drift down from the 50s to the 40s. We might select the 40 strike as our strike for a calendar spread. So, for example, we might go ahead and go to our option screen here for, let's see, for January, and we might buy a January 40 put. And so here I'm clicking on the offer for that. And well, let's see, go out even farther. Let's go out to March. Give ourselves time here, okay? Maybe stuff kind of just hangs out for a while, but we know it's going lower. So we give ourselves time. We got to March, 124 days till expiration. We pick up the 40 put, okay? Then against that, we're going to sell. Now, we have talked about selling a lower strike, but you can also just sell this strike. So maybe we sell the DEES 40 put, okay? So DEES 40 put, $1.75 here. So you would be paying $470 each time you do this trade. So let's say that's about $500. So let's say we did that 10 times for a little under $5,000, okay? Let's put this trade on 10 times. If I right-click here and select Analyze Trade, we can look at this in our little Analyze Trade tab, and I'm going to get rid of the other trades that I had on there. And if we were to buy this 10 times, that would make us short 38 deltas and collecting $22 a day in decay. And excuse me. And one way to look at these trades when we analyze them is to move the time calendar forward. So I'm going to move the time forward on this and see how my deltas change, okay? So I see as the days move forward, my delta gets shorter and shorter, and my theta increases also. And my theta increases to a certain point, and then it doesn't increase anymore. That's because we're pretty far away from the strike here. If we were to get a little closer to the strike here, for example, let's say it moves down to 45 in a month. Your theta is going to be a lot higher. You know, the optimal thing for a trade where you're selling an option is for it to go right to that strike. So as we, we're expecting a gradual move down. And if this makes a gradual move down, then that would be optimal. Our deltas will slowly flatten out when we actually get to the strike. But the longer it doesn't move down, if we just sit at 50, as time goes by, our delta gets shorter and shorter, which is good for us because the longer that goes by that this does not go lower, the more the chances are that it is going to, because it's eventually going to go lower. We know that. So as time goes by, our delta gets shorter, and that's a good thing because it becomes more and more likely that we're going to go lower as time goes by. And so as this creeps down, we make money. But let's talk about right now, the most important thing is to not lose money. B, yeah, it's great to make money. But A, let's not lose money on the spikes and things like that. So the beauty of this trade, and it looks like, let me reset everything here. The beauty of this trade is that it doesn't attach a super short delta right away. And so if stuff does go against us for a couple of days, you'll find that you'll be grateful that you don't have like just a huge short delta, because you can withstand up move days. You're collecting money every day, and so that helps to cushion any up moves. And once again, you're long some Vega, so if volatility expands, that helps you as well. So these trades can be very you'll be thanking yourself that you have a calendar on instead of just a vertical spread for your short delta, because you won't get hurt as much on a spike with this position on, which is great. The second great thing is that if you do get a spike, and let's say this pops back to 70, you can adjust your position at that point and turn it into more of a raw delta play, but you still have enough money in your account to survive. So I think that long calendar spreads can be a great way to survive these kind of rocky waters. And we may be in kind of volatile times for a while now. I mean, as the financial newspapers report, we're in the 9th year of a bull market, and people see things that way, and we could have volatility for a while here. So we want to try to survive and not lose too much money during these times of volatility, so that when things calm down again, we have enough capital to continue to make money on the short vol trade. So consider calendar spread as an alternative to either just being straight up short shares of UVXY or VXX, or long put spreads or short call spreads. We get a lot of questions about long short put spreads. We get a lot of questions over which should you do, sell a call spread or buy a put spread. And I always like to remind people that the two are related, and you can think of selling a call spread as the same thing as buying a put spread, and they're synthetically related. So I would suggest that they're interchangeable, and whichever one has the better pricing would be the one to pick. People talk about getting assigned on short calls that are way in the money, and that is possible. You could also be assigned on puts that are way deep puts, but the two spreads are relatively the same thing. Selling a call spread or buying a put spread, they're very similar to each other. So I have no preference other than price between the two. Anyway, this is just a brief little video today, and I plan on answering more of your questions and getting more into detail later on this week. Thanks for watching, and we will see you next time on the Short Vol Show Live.